Hi, I'm Mario Correa, and I had a client who has agreed to be off screen, but allow me to explain to her while we're videoing what is going to happen now that a family member's passed. And they just want to kind of understand the whole process. So I'm going to go ahead and explain it to you. Basically, it's not estate planning as much as it is asset planning. So really, we have to go individually by assets. And the major assets in this estate, and I'm going to just use fictitious numbers, but the assets in this estate, which is common, is we have a house, we have bank accounts, and then we have retirement accounts. Okay, I want to go over one major item, and then we obviously have personal property. Personal property. Okay, that's furniture and cars and such items. So let's begin. What we really do is we focus on the individual asset. So we have to ask ourselves, who owns this asset? And once we look at the assets, so for the house, what we're going to do, and our firm will do, is we're going to pull title. That means we're going to look at the deed. Okay, and what that deed is going to tell us is how the asset was owned. Now, in your case, you had gone to another firm and had prepared a deed. So
That's
that
correct.
we're in good shape there because there was a deed and trust. So there was a trust. So we look at the deed, and we literally look who the grantor is. And when the grantor has the name of the trust, it owns it, then the trust governs. And that's an additional benefit because you don't have to go through probate estate when you don't have to go to probate. As long as we're below 100,000 in all these assets in the aggregate, we won't have to go to probate. In your case, now, you were supposed to, from what I understand, you were supposed to have, you have a bank account. Now, the bank account's name was in your mother's name, and that says put down an arbitrary amount. It was about, let's say it was around 30,000. Okay? So I look at that bank account, and what I'm going to try to do is identify two things. Who owned it, and here the owner, when you contact the bank, is going to tell you it was the decedent, mom. And it's also going to tell you if there was a beneficiary. If there's a beneficiary, now in your case there was not. It would have been better if you would have made the beneficiary the trust, because then the trust would govern. But that wasn't the situation here. So here, this asset is going to be subject to probate, or potentially subject to probate. Okay? Now, in your situation, what that probate means is either we have a will or we don't have a will. But we'll talk about that in a little bit. Retirement accounts. Okay? Your mother did have an IRA, and it did have beneficiaries. It was your father, and this account was around 80,000. It did have your father. The problem is your father's deceased. There were no backup ones. So once again, this is a probate asset. Okay? So we're literally going individual asset by individual asset. Personal property, there was, the value is de minimis, let's say $10,000, but there was never a transfer into the trust. In order to transfer personal property into a trust, you have to do a personal assignment. So this one's going to be governed by probate as well. Okay? So now what's going to have to happen is, fortunately, when your mother did her estate plan, she had a will. And what the will said is, so let me take a step back and talk about probate. So now we're talking about probate. Probate is either you have a will or you don't have a will. Your mother had a valid will, and it was a specific type of will. It was a will that said give everything to the trust. It's called a pour-over will. And that poured into the trust, so the trust governs. Okay? Now the trust governs, then we know that, so basically all these assets that are going through probate, the trust will ultimately govern, which as we've discussed, is going to be helpful for you and your siblings. Because that's everything's going equally, so that's going to take care of it. So what we do, and what document controls depends on the underlying asset.
So if the trust governs, now that we have this pour over will, do these properties, do they have to be put into the trust?
They do. They will have to be put into the trust. Can we do an assignment? Yes, we could do an assignment where the family directs us, let's just distribute out directly. That's not the best way to do it, though. The way we normally do it is we're going to create a bank account.
Bank account.
Our firm will get you a taxpayer identification number, and we're going to take that bank account, and that bank account is going to be in the trust name with the trust EIN, and inside that bank account, we're going to close this bank account, which once you tell the bank and we're giving the death certificate, they're going to freeze it anyway, and we're going to transfer everything into this bank account, the trust account. With this retirement account, we're going to transfer everything into this account. Then what we're going to do is once we have all the money in the account, we're going to prepare an accounting, and we're going to say what we started with, which is what we call an inventory, and we're going to literally break that out. Here's the house, here's the bank account, here's the other account, and here's the personal property that we know of in a general way. Like a car, you might identify separately. You're not going to identify this as furniture separately. That will do it. We'll go into more detail at another time. Okay? So now you have the trust account, you have the bank account. The bank account shows us all the transactions that have occurred. We're going to prepare what's called an accounting. So now let's go to the next steps. Next. So we're going to consolidate. First off, we're going to review assets. We're going to consolidate. And actually, in this instance and in your family, we're going to be selling the house too, so that'll eventually go into the trust as well. Then we're going to consolidate. Then we're going to account. We're going to give all the beneficiaries the accounting and show them exactly what happened. We're going to start with our beginning inventory, saying, look, these were all the assets. We liquidated the assets, and this is the cash on hand. And now we're going to divide it out into 3 separate parts, one for every family member, for every child, because that's what the trust says. So now we're going to account. We're going to ask for releases. So we're going to go to our beneficiaries. And we're going to say, here's our accounting, here's our numbers, here's how we think the proper way to spread the money is, or cut the checks. And in your family where everyone's working, everything's working nicely, you all get along, then those releases will be, once we get those releases back, we'll cut checks. Of course, another step is we'll also do we'll do a holdback for our tax return. The tax return should be de minimis, holdback for taxes. Well, maybe not that de minimis, because on this $80,000, we're going to be paying some taxes. And then we'll talk to our CPA about that and how best to hold back, and then we can close out the estate.
Okay.
So that's kind of the roadmap from start to finish. So really the next step is what we're trying to figure out, what the assets are, where it's all going to go, and then we're going to have to be accountable for everything. But then we're going to distribute just how it says in the trust. We're going to follow that. Make sense?
It does.
All right, great. That's the trust administration process.